AI investing tools are everywhere. Millions of people are using them right now. And most of them are quietly losing money because of three mistakes nobody talks about. Here is the uncomfortable truth. The problem is not the tools. The tools are actually incredible. The problem is the way people use them. And once you see exactly what goes wrong, you will never make these mistakes again. Let's start with the biggest one. Mistake number 1, treating AI output like financial advice. This is where most people fall apart. They open ChatGPT, they type something like, "What stocks should I buy right now?" And then they actually follow the answer. Sometimes they put real money behind it, hundreds of dollars, sometimes thousands. Here's what you need to understand. AI language models are trained on data with a cutoff date. That means the model giving you stock picks could be working from information that is 6 months to a year old. Markets move in days, sometimes in hours. Acting on stale AI data is like navigating a highway with last year's map. There is also a deeper problem. These models are trained to sound confident. They will give you a clean, well-structured answer, whether the underlying information is solid or not. Researchers at the University of Michigan found that people rate AI-generated financial advice as 34% more trustworthy than the same advice from a human. That is terrifying, because trustworthy tone and accurate information are two completely different things. The fix is simple, but most people skip it. Use AI as a research assistant, not a decision maker. Ask it to explain concepts. Ask it to summarize earnings reports you paste in. Ask it to compare two strategies you are already considering. The moment you ask it what to do with your money, you have handed the steering wheel to something that cannot see the road. Mistake number 2. Over-automating without understanding what you are automating. This one is sneaky because it feels like efficiency. There are AI-powered tools right now that will automatically rebalance your portfolio, automatically execute trades, automatically move money between accounts based on market signals. Some of them charge between 0.25% and 0.75% annually for this service. Sounds small. On a $50,000 portfolio, that is up to $375 a year. On $200,000, that is $1,500 a year, every year, for a system you may not fully understand. The issue is not automation itself. Automation can be genuinely powerful. The issue is blind automation. When the market dropped 12% in 3 weeks during early 2022, many automated systems triggered selling rules their owners had set up but forgot about. People woke up to find they had locked in losses automatically. No human ever pressed a button. The system just did exactly what it was told to do, which was not what the owner actually wanted. Before you automate anything, you need to understand 3 things. What triggers the action, what the action actually does to your position, and what the exit looks like if you want to stop. If you cannot answer all 3 in plain language, do not automate it yet. The smartest investors use AI automation for low-stakes, repeatable tasks. Automatic contributions to index funds, dividend reinvestment, rebalancing once a quarter within a target range you set manually. These are boring. They are also exactly right. Now, here is something that is going to change how you think about all of this, and most financial creators will never say it out loud. The investors who are winning with AI tools are not the ones using the most advanced tools. They are the ones using the simplest tools more consistently than everyone else. A person who automatically invests $400 a month into a low-cost index fund using a basic robo-advisor and never touches it will outperform the person frantically switching between AI stock screeners 80% of the time over a 10-year period. Vanguard's own research found that investor behavior, not fund selection, accounts for roughly 1.5% of annual return drag for the average retail investor. That gap compounds. Over 20 years at 7% average returns, a $10,000 investment becomes about $38,700. That same $10,000 with 1.5% less return annually becomes just $28,400. The difference is over $10,000. Not from picking better stocks, from stopping yourself from doing too much. This is the retention trap most people fall into with AI investing. They think more activity equals more return. It almost never does. Mistake number 3, ignoring the cost layer hiding inside AI investing platforms. This one costs people money every single month, and they never see it on a single statement. Here is how it works. You sign up for an AI investing platform. Maybe it is free to start. Maybe it charges a small monthly fee, something like $3 to $12 a month. What people do not check is what is underneath. The funds the platform puts you in, the expense ratios on those funds, the transaction fees that trigger when the AI rebalances, the spread between buy and sell prices on assets the system trades frequently. Run the full math. If your AI platform charges $8 a month, that is $96 a year. If the funds it chooses carry a 0.5% expense ratio and you have $30,000 invested, that is another $150. Add in rebalancing friction costs, estimated conservatively at $40 to $80 a year for an active strategy, and you are looking at $280 to $326 in annual drag before your money earns a single dollar. Compare that to a simple 3-fund portfolio at Fidelity with 0 expense ratios on their index funds. The cost difference alone, reinvested over 15 years, could exceed $7,000. This does not mean AI platforms are bad. Some of them are worth every penny, especially for people who would otherwise make emotional decisions and destroy far more than $300 in returns. But you have to do the math. You have to know what you are actually paying. The way to check this is simple. Pull up any platform you are using or considering. Look for the fund prospectus, not the marketing page. Find the net expense ratio, then use a free fee analyzer. Most brokerages have one built in to see the 20-year cost projection. The number will surprise you. Now, let me connect all of this to something practical you can start using today. If you want to use AI tools correctly for building wealth, here is the actual framework. Use AI to learn faster. Use simple automation to execute consistently. Use manual review to check costs and triggers every 90 days. The learning part is where AI genuinely shines. You can take a dense 40-page annual report and paste sections of it into an AI tool and ask it to summarize the key risks in plain language. You can ask it to explain what a PE ratio means in the context of a specific industry. You can ask it to walk you through the difference between a Roth conversion and a backdoor Roth. That kind of on-demand financial education used to cost hundreds of dollars an hour with a financial planner. Now it is free. And here is where I want to bring up something that has genuinely helped me understand how to use content and tools together more strategically. If you are building any kind of audience around your financial journey, whether that is a YouTube channel, a newsletter, or even just a personal finance blog, TubeBuddy is one of the most useful tools I have come across. It helps you understand what people are actually searching for, which means you stop guessing and start creating content around real questions real people have about money and AI investing. It uses data the same way a smart investor uses data, not to tell you what to do, but to show you what is actually happening so you can make better decisions. The free version alone is worth installing just to see how your content or your competitor's content is performing. The reason I mention it here is that building wealth on autopilot is not just about your portfolio. It is about building systems that generate value over time with less and less active effort. A well-optimized video does that. A properly structured investment account does that. Both require the same mindset. Set it up right once, let the system run, check it periodically, and resist the urge to over-tinker. That urge to over-tinker is what kills most people's results, with AI investing tools and with everything else. Here is your action item before you close this video. Open whatever investing platform you use right now. Find the actual expense ratios on every fund you hold. Add up your total annual cost in dollars, not percentages. Then ask yourself honestly whether that cost is earning its keep. If you cannot answer yes with confidence, you now know exactly what to fix first. If this gave you a new way to think about AI investing mistakes, subscribe. New videos drop every week, and every one of them is built to give you one thing you can actually use.